Welcome back to another deep dive. Today, I want to start by asking you a question that might feel a little bit invasive. I want to ask about your pulse.
We're getting physical right out of the gate today.
Metaphorically physical, yeah. I want you to imagine a patient lying on a table in a hospital. You're the doctor. You're standing over them, looking at that monitor. You know, the one with the squiggly green line and the constant beeping sound.
The vital signs monitor.
Exactly. That monitor tells you everything. It tells you if the patient is, resting comfortably, if they're struggling for breath, or if they're essentially ready to get up, rip out the IVs, and go run a marathon.
Right.
Now, take that image, that whole life or death monitoring thing, and map it onto your business, or maybe your real estate portfolio, or honestly, even just your personal checking account.
We're looking for the financial heartbeat, the financial EKG.
We are. And in the massive stack of research we went through for this deep dive, and we have a lot of it today, everything from banking guidelines to these fascinating S&P case studies from the financial crisis, it turns out that heartbeat isn't a squiggly line.
Yeah.
It isn't some vague feeling of, yeah, I think we're doing okay. It's a number, a single ruthless number.
It's the DSCR, the debt service coverage ratio.
Which I have to say has got to be one of the driest, most boring sounding names in the history of finance. Debt service coverage ratio.
It does sound like homework.
It sounds like something you scroll past in the terms and conditions without reading, It sounds like the kind of thing that makes your eyes glaze over before you even finish saying the words.
It does sound dry, I'll give you that. It sounds like compliance paperwork. But I would argue, and the source material supports this emphatically, that it is the single most important metric for survival. Period.
For survival.
It is the difference between a business that owns its future and a business that is slowly, quietly being repossessed by the bank.
Survival. That's a really big word. We usually talk about things like profitability or, growth, but you're talking about sheer existence.
I am using that word deliberately. Because you can have great ideas, you can have amazing marketing, you can have a beautiful storefront and customers lining up around the block. But if this one number, this DSCR, is wrong, you are dead. You just don't know it yet. It measures one thing and one thing only. Can you generate enough actual cash to pay what you owe?
So, okay, our mission today is to take this dry acronym and turn it into something you can actually use. We're going to rip apart the dictionary definition and really look at how banks use this number to decide your fate. We're going to look at the hidden traps, and there are specifically some tax traps in here that honestly blew my mind, that can bankrupt you even if you think you're profitable.
And we have a really fascinating detective story right in the middle of this involving the 2008 financial crisis, which shows what happens when you ignore the nuance of this number. It effectively shows how you can drown in a river that is, on average, only 2 feet deep.
I love that analogy. Okay, so buckle up. We are checking the pulse. Let's start with the basics. We kind of need to do a little anatomy lesson on the ratio itself.
The formula?
The formula. The source material lays it out, and it looks simple enough on paper. DSCR equals net operating income divided by total debt service.
Numerator and denominator, top and bottom, simple fraction.
Let's start with the top half, the numerator.
Right.
Net operating income, or NOI. Now, I feel like I know what income is. Money comes in, I put it in the bank. But net operating income feels like it has some strings attached. It feels like an accountant's term.
It has very specific strings. And this is where people get tripped up immediately. Net operating income is, at its core, your gross revenue minus your operating expenses.
Okay. Revenue minus expenses. That just sounds like profit to me.
Well, hold on. It really depends on how you define expense. This is the crucial distinction. When you are calculating NOI for the purpose of this ratio, you are trying to figure out the raw efficiency of the business itself.
The machine.
Yes. You want to know how the operation is performing, completely independent of how you paid for it or how the tax man treats it.
So we're looking for the purity of the business model.
Exactly. So think about what you normally subtract from your bank account. You pay the electric bill.
Right.
You pay the staff. You pay for raw materials. You pay for insurance. Those are all operating expenses. They are required to keep the doors open, to keep the lights on. So those get subtracted.
Okay, that makes perfect sense. Those are the costs of doing business.
But, and this is the big but, there are things you don't subtract.
Yeah.
And the big one, the one that confuses absolutely everyone, is financing costs. You do not subtract the interest on your loans.
Wait, let's pause right there. Because if I have a loan, I have to pay the interest. If I don't pay the interest, the bank takes my business. Why on earth wouldn't I count that as an expense? It feels like a very real expense to me.
It is a real expense, but remember, the goal of the DSCR. The DSCR is a test to see if you can afford the financing. You can't subtract the interest to find out if you can afford the interest.
Ah.
It's circular logic. It's like asking, how much money do I have left after I spend all my money? We need to know how much cash the machine spits out before the bank takes its cut.
Okay, I think I see where you're going. It's like checking the horsepower of a car engine.
That's a perfect analogy. Go on.
You want to know how powerful the engine is? That's the NOI. It doesn't matter if you bought the car with cash or if you financed it with some terrible high-interest loan. The engine has the same horsepower regardless of the financing.
Precisely. The engine doesn't care about your loan terms. So, we exclude interest from the expenses to see the raw power. We also exclude personal income taxes of the owners. And here's another big one that throws people off. We exclude capital expenditures and depreciation.
Depreciation. Yeah, let's stick on this for a second. Because in the world of accounting, depreciation is a massive deal. I buy a piece of machinery for $1 million or I buy an apartment building, and my accountant tells me I can write off a chunk of that value every year as an expense. It lowers my taxes.
Huh?
But you're saying for this ratio, we ignore it.
We ignore it completely. We actually add it back in if it's been taken out.
Why? I mean, if my building is getting older, the machine is wearing out, isn't that a real cost?
It is a cost in an accounting sense. It's an allocation of a past cost over time. But DSCR is a cash flow metric. It's not an accounting trick. It's a reality check. When you claim depreciation on your taxes, do you write a check to the Department of Depreciation?
No, of course not. I don't send money anywhere. It's just a line on a tax form.
Exactly. It is a paper loss.
Yeah.
No cash leaves your bank account. The money is still there. So since the bank wants to know how much cash you have available to pay them, they add that depreciation back in. They want to see the real, tangible cash.
So we're stripping away all the accounting fiction. We aren't interested in taxable income or what the tax form says. We are interested in the raw, bloody cash flow that is sitting in the register at the end of the day.
Vivid, but yes. That is the numerator, the NOI, the cash-generating power of the asset.
Okay, that's the top. Now let's look at the denominator, the bottom of the fraction, total debt service. Now, usually when I hear service, I think of getting my car fixed. But in finance, debt service just means the bill.
It is the bill, but it's the whole bill. And this is where the symmetry with the numerator gets really interesting. Remember how we ignored interest in the top part?
Right. We kicked it out to see the raw power of the engine.
Well, we put it back in here on the bottom. Total debt service includes your interest payments. It includes any lease payments you might have. And this is the critical part. It includes your principal repayment.
Okay, so this is just the total monthly check I write to the lender. Supple enough.
Correct. But there is a nuance here that the sources point out, and it's really important. We are including principal repayment as a cost here.
Which feels normal to me as a payer. I have to pay it. It costs me money.
It feels normal to you, but to an accountant, that's weird. Because typically, paying down principal isn't an expense on a profit and loss statement. It's just moving money from one pocket to another.
How so?
Well, you're taking cash, which is an asset, and you're using it to reduce a liability, your loan. The net effect on your wealth, your net worth, is zero. You're just changing its form.
Right. If I pay off $1,000 of my mortgage, I own $1,000 more of the house. I'm basically paying myself, in a way. I'm increasing my net worth.
Exactly. That's the balance sheet view. But a lender does not care about your net worth on paper. They care about your liquidity. Even if you are paying yourself in equity, that cash has left the building.
Yeah.
You cannot use that cash to buy inventory. You cannot use that cash to pay salaries. It is gone. It's no longer liquid.
That is a really, really critical shift in mindset. We aren't looking at, am I getting richer? We're asking, will I run out of cash this month?
Correct. It is a liquidity test, not a profitability test or a wealth test.
Yeah.
If you can't pay the principal, you default. It doesn't matter if your equity is going up on paper. If the cash isn't there to make the payment, the game is over.
So we have the theory, NOI on top, that's the raw cash engine, and total debt service on the bottom, the whole bill. Let's ground this. The source material gives us a character. Let's call him Mr. Jones.
Good old Mr. Jones. The everyman of financial case studies. He's always buying a duplex.
So Mr. Jones decides to become a real estate mogul. He buys a duplex, he rents it out, he collects the rent, he pays the plumber, he pays the insurance, he pays the property tax. After all those operating expenses, he is left with his net operating income.
His NOI.
The source says his NOI is $36,000 a year.
Okay, so that's $3,000 a month of pure cash flow generated by the building. That's his raw engine power.
Now he looks at his mortgage. He has to pay the bank principal and interest. His total annual debt service is $30,000.
$2,500 a month.
So we do the math. $36,000 of income divided by $30,000 of debt. What do we get?
We get 1.2.
So Mr. Jones has a DSCR of 1.2. Now, put that in plain English for me. What does 1.2 actually mean for his life? What does it feel like?
It means he has a cushion. Specifically, it means for every $1 he has to pay the bank, his property is generating $1.20.
Okay.
So he has 20% more cash coming in than he needs to send out. He pays the bank the $30,000, and he still has $6,000 sitting in his account at the end of the year.
That's his breathing room.
It's his margin for error. If a tenant moves out for a month and he loses some rent, or if the roof springs a leak, or if insurance premiums go up unexpectedly, he has that $6,000 buffer before he has to start digging into his own personal pocket.
And that brings us perfectly to the next section, the magic numbers. Because 1.2 sounds good, but is it good enough?
That is the million-dollar question, or perhaps the multi-million-dollar loan question, depending on the deal.
The sources draw a very, very hard line in the sand at the number 1.0.
1.0 is the break-even point. It is the absolute edge of the cliff.
If my DSCR is exactly 1.0, that means my income is exactly equal to my debt, 30,000 in, 30,000 out.
You are treading water, and the water is right at your lower lip. You aren't drowning, but you are not moving. You have zero profit. But more importantly, you have zero resilience.
Right. Because if anything goes wrong, even a tiny bit, if the ratio drops to 0.99...
You are underwater. You are drowning.
Let's play out a scenario where the ratio is, say, 0.8. What does that life look like for the owner?
A DSCR of 0.8 means your property is only generating 80 cents for every dollar of debt you owe. So you have a bill in your hand for $1. The business gives you 80 cents. You're holding the bill. Where does the other 20 cents come from?
It has to come from me, from somewhere else.
It comes from your personal savings. It comes from your salary as a dentist or a teacher or whatever your day job is. It comes from your kid's college fund. Every single month, you are writing a personal check to subsidize this investment. You are actively bleeding money.
This is what they mean by cash flow negative.
It's a very polite, clinical way of saying money pit.
So obviously banks hate anything below 1.0,
Okay.
but do they accept 1.0? If I walk into a bank and say, hey, look, this deal breaks even perfectly, will they give me the loan?
Almost certainly not, no. Because bankers are professional pessimists. Their job is to imagine everything that can go wrong.
Right.
They know that the world is chaotic. They know that HVAC systems die 2 days after the warranty expires. They know that good tenants lose their jobs. If you start at 1.0, the first distinct breeze will blow you right over the cliff.
They want a buffer, a cushion.
They demand a buffer. In commercial real estate, the magic number is typically around 1.25.
So they want the income to be 125% of the debt.
Right. They want a 25% margin of safety. If you walk in with a deal that's a 1.05 or a 1.1, they'll likely show you the door. Or they will negotiate.
How do they negotiate that? Do they ask you to go back and increase the rent on the property?
They might suggest that, but usually they attack the denominator, the part they control. They say, we can't lend you this much money because the payments are too high for the income. So they lower the loan amount. If you borrow less, your monthly payment goes down. If the denominator of the fraction goes down, the ratio goes up. So they force you to put in a bigger down payment to make the math work for them.
That makes perfect sense. They manipulate the loan amount until the ratio hits their comfort zone. It protects them.
Exactly. And you, the listener, you need to understand that this isn't just a hurdle you jumped over once at the beginning to get the money. This number, it haunts you.
What do you mean by that?
The sources talk about loan covenants. These are process rules written into the fine print of the contract. A bank might put a clause in your mortgage that says you must maintain a DSCR of at least 1.20 at all times for the life of this loan.
And if my rents dip for a few months and I drop to 1.15?
You are in technical default.
Wait, seriously? Even if I make the payment, let's say I write the check for the full amount on time, the check clears, but my income drops slightly, so my ratio is 1.15. The bank can still call the loan.
Yes. Technically, you have broken the promise. You have become a riskier borrower than the one they agreed to lend to. Now, usually they won't foreclose immediately. Banks don't want to own real estate. It's a hassle.
Right.
But they can use that default to force you to restructure. They can raise your interest rate. They can demand you put more cash in a reserve account. They can seize control.
That is terrifying. It's like getting a speeding ticket even though you didn't crash the car.
It's risk management. They don't want to wait for the crash. They want to intervene when you start swerving. That's why understanding this number is so critical. It's not just about getting the loan. It's about keeping the loan.
Now, does this apply to everyone? Or is this just for, big corporations and real estate moguls?
The math applies to everyone, but the context changes a little. In corporate finance, for instance, they use it to verify if a company can handle a big bond issue. They look at something called sinking funds.
Sinking funds, that sounds ominous. Like a ship going down?
It's actually a safety mechanism. It's the opposite. It's money that is set aside, sunk, into a separate account, specifically to pay off the principal of a bond when it matures in, say, 10 or 20 years.
Ah, okay.
The DSCR calculation for a corporation will include those sinking fund contributions to make sure the company is actually saving up to pay the big bill at the end.
And for personal finance, does this matter for me if I'm just buying a house to live in?
Absolutely. 100%. If you go to get a mortgage or a car loan or a personal loan, the loan officer is doing a version of this math. They might call it debt-to-income ratio, which is kind of the inverse, but the logic is identical.
Right.
They look at your pay stub, that's your NOI, and your current debts, your student loans, your credit cards, that's your debt service. If the ratio is too tight, you get the application denied letter.
There was one other term in the source material that caught my eye. DSRA, the Debt Service Reserve Account.
Yes. This is big in project finance. So think massive infrastructure, building a toll road, building a power plant, a wind farm.
Okay. Big long-term stuff.
Very big stuff. Let's say you build a toll road. Most months, traffic is great, predictable. But maybe one month there's a massive blizzard and nobody drives for 2 weeks. Your revenue tanks. Your DSCR for that period drops way below 1.0.
You can't pay the debt.
Right. But you can't just foreclose on a toll road or shut down a city's power plant easily. So the lenders require a DSRA. It's a literal bucket of cash, usually 6 months to a year of bet payments, just sitting in a locked account.
An emergency fund.
It's an emergency fund, but it's mandated and controlled by the bank. If you have a bad month, you dip into the bucket to make the payment. It artificially fixes the ratio for that month and keeps the project from going bust over a temporary glitch.
It smoothed out the bumps.
Exactly.
So we've established that the DSCR is a survival metric. We know the benchmarks. But benchmarks are just averages. And averages can be dangerous liars.
They can be profoundly misleading.
This brings us to the detective work section of our deep dive. The sources included a really fascinating case study from the 2008 financial crisis involving Standard & Poor's, S&P, and Bank of America.
This is a classic example of why you can't just look at the top-line number and call it a day.
So set the scene for us. It's June 2008.
Which, if you recall, is right as the financial crisis is starting to rumble. The tremors are really starting. Bear Stearns has already collapsed a few months earlier. The housing market is cracking wide open. There's a lot of fear in the air.
And in the middle of all this, S&P, the rating agency, issues a press release. They are downgrading the credit ratings on a pool of commercial mortgage certificates from Bank of America.
Specifically, it was the 2005-1 series, a pool of loans made a few years earlier.
And the reason they give is credit deterioration. Now, usually that sounds vague and corporate, but they get very specific. They say that out of a pool of 135 loans, 8 specific loans had dropped below a DSCR of 1.0x.
8 loans out of 135, so that's roughly 6% of the pool.
And because of those 8 loans, just 6% of the total, they downgraded the certificates that were backed by the entire pool. Now, here's where the detective work comes in. The sources break down the data on these bad apples.
Right. And this highlights a key point for anyone analyzing anything. It is not enough to just know the current DSCR. You need to know the rate of deterioration, the trajectory.
How fast is the patient crashing?
Exactly. Is it a slow decline or a nosedive? S&P reported that these 8 loans, which were underwater with a DSCR below 1.0, had an average balance of about $10.1 million. But here's the kicker. Their DSCR had declined by an average of 38% since the loans were first issued.
Wow, 38%. So they didn't just drift down, they plummeted. That's a catastrophic drop.
A 30% drop in income coverage is massive. That tells an analyst that something is fundamentally structurally wrong with those properties or their management. They are hemorrhaging cash.
So you have these 8 disasters, the 6% of the portfolio that's on fire. But here is the twist. And this is what I call the paradox of averages. The source asks a really obvious question. If 8 loans are failing, what does the rest of the pool look like? What is the DSCR for all 135 loans combined?
And this is where it gets so fascinating and, frankly, so counterintuitive. The weighted average DSCR for the entire pool was 1.76x.
1.76, that's great. I mean, that's way, way above the 1.25 safety zone we were just talking about. That sounds incredibly healthy.
It is. It's a fantastic number on its own, but it gets
Uh-oh.
even stranger. The original weighted average for the pool back in 2005, when those 8 loans were presumably healthy, was 1.66x.
Wait, let me get this straight. The pool, on average, got healthier.
Yes. The weighted average DSCR actually improved from 1.66 to 1.76 over those few years.
How is that even possible? You have 6% of the pool collapsing, dropping 38% in coverage, yet the overall average goes up. That doesn't make any sense.
This is the danger of averages. It's a perfect illustration. While those 8 specific loans were rotting from the inside out, the other 127 loans were likely doing quite well.
Mm-hmm.
Maybe the owners of those properties were paying down their principal aggressively, which lowers their debt service. Maybe their rents went up. Since the calculation is weighted by loan size, the success of the healthy majority completely masked the catastrophic failure of the minority.
That is such a crucial lesson. If you just looked at the headline number, portfolio DSCR improves to 1.76, you'd think everything was perfect. You'd think, wow, what a solid investment. I should buy more.
And you would be completely missing the rot in the foundation. You'd miss the fact that over $80 million worth of loans, 8 loans at around $10 million each, were on the verge of default.
It's like the Titanic. Imagine you calculate the average dryness of the passengers on the Titanic as it's sinking. Most of the people are still on the upper deck, sipping champagne, waiting for the lifeboats. They are perfectly dry. A few hundred people in steerage are already underwater, but if you average it out across everyone, the report says, status, mostly dry.
That is a darker way to put it, but yes, it's a perfect analogy.
Yeah.
The average depth of the water on the ship might be low, but for the people in the steerage, that average is meaningless. They're drowning.
So for you listening, the takeaway here is don't just trust the top line number. You have to dig into the distribution. You have to look at the outliers.
Absolutely. A high average DSCR doesn't guarantee safety if there's a concentrated pocket of extreme risk. And conversely, as we said, a DSCR below 1.0 doesn't guarantee default. But it is a blinking red light that demands your immediate attention. You have to look at the loan level data.
Okay, speaking of looking closer, we need to move to the final section of our dive. And I'm going to warn you now, this is the advanced class.
This is the double black diamond run of financial metrics for sure.
We are going to talk about taxes, and specifically a fundamental flaw in the standard DSCR calculation that, according to our sources, leads people to think they are safe when they are actually quietly going broke.
The pre-tax provision method.
It sounds incredibly intimidating. But the concept starts with a simple question. How does the IRS, the tax authority, treat your debt payments?
And the answer is inconsistently. Very inconsistently.
Okay, so let's start with the easy part. We know that interest is tax deductible.
Right. If you run a business, interest is an expense. You subtract it from your income before you calculate your taxes.
Right.
So if you earn $1 and you pay $1 of interest, you have 0 profit and you pay 0 tax. You pay the interest with pre-tax dollars.
Very efficient. But what about principal?
Principal is not tax deductible.
Repeat that for the people on the back. That seems really important.
You cannot deduct principal repayment. You have to pay principal with after-tax dollars.
Okay, I want to make sure I really, really get this. Let's say I have a lemonade stand. I borrowed money to build the stand. This year, I owe the bank $1 in principal.
Okay. You owe $1.
I sell enough lemonade to make exactly $1 of profit. I take that dollar and I hand it to the banker to pay the principal. We're good, right? I'm all square.
No. You are in jail, or at least you're in very deep trouble with the IRS.
Why? I made $1, I paid $1, I have nothing left.
Because you made $1 of profit. The IRS wants its cut of that profit. Let's say the tax rate is 35%. The IRS wants 35 cents from you.
But I gave the dollar to the banker. I don't have it anymore.
The IRS does not care. They don't care what you did with the money. You earned the profit. You owe the tax. The fact that you used the cash to pay off a loan is your problem, not theirs.
So in order to pay the banker that $1, I actually needed to earn more than $1.
Exactly. You needed to earn enough to pay the tax man and still have a full dollar left over for the banker.
This is the tax trap. Now, the standard DSCR formula, the simple NOI divided by debt, does it account for this?
Generally, no. It treats all cash flow as equal. It assumes a dollar of cash is a dollar of cash. It forgets that some of those dollars have a tax toll on them before they can be spent on certain things.
This leads to the distinction the sources make between EBITDA and EBITDA. These acronyms get thrown around a lot.
Yes, EBITDA earnings before interest, taxes, depreciation, and amortization. It's a classic metric. The sources say EBITDA is great for measuring your ability to make interest-only payments.
Because interest is pre-tax, so it matches up.
Exactly. But if you have to pay principal, which is post-tax, you should be looking at EBITDA without the T for taxes. Or, more accurately, you need a method that actually accounts for the tax bite on the principal portion.
Enter the pre-tax provision method.
Right. This method tries to solve that exact problem by calculating exactly how much pre-tax cash you need to set aside or provide to meet all of your post-tax outlays.
And post-tax outlays being things like principal payments, but also paying dividends to shareholders or any capital expenditures that you can't finance with new debt.
Correct. Anything you have to pay with clean after-tax money.
Okay, I want to walk through the logic of this calculation because it's really clever.
Yeah.
It involves a comparison between your non-cash expenses and your post-tax outlays.
It's a balancing act. On one side of the scale, you have your non-cash expenses, and the big one is depreciation. We talked about this earlier. Depreciation is a beautiful thing for cash flow because it shields your income from taxes.
Right.
You report a loss on paper, the depreciation, but you keep the cash. It's like a tax-free allowance from the government.
So depreciation gives me a bucket of tax-free cash.
Exactly. So, scenario A. Let's say your depreciation for the year is greater than your principal payments.
Okay, so my tax shield is bigger than the thing I need to shield?
In this case, you are safe. You are in good shape. You can use that cash, which was shielded from taxes by the depreciation, to pay the principal. You don't take an extra tax hit. The provision is just the amount of the principal. $1 of debt needs $1 of cash. Simple.
But then there's scenario B, the ouch scenario, as the source calls it.
This is where your principal payments are greater than your depreciation. You have exhausted your tax shield, you used up all your depreciation credits for the year, but you still owe more principal to the bank.
So that extra amount of principal is exposed to taxes. It's unprotected.
It is naked. To pay that extra unprotected principal, you must earn extra pre-tax income to cover the principal plus the taxes on that income.
The sources give a really concrete example of this. Can we run the numbers?
Let's do it.
Yeah.
So imagine a company, they have post-tax outlays, let's just call it, principal for simplicity of $100 million.
Okay, they owe the bank $100 million in principal this year, a big bill.
But their non-cash expenses, their depreciation is only $50 million.
So they have a $50 million shield, but a $100 million bill. There's a mismatch.
Right. So the first $50 million of the debt is covered. It can be paid using that cash that was shielded by the depreciation. No tax problem there. But they still have another $50 million of principal left to pay.
And no depreciation left to hide it from the IRS.
Correct. So assuming a 35% tax rate, they can't just go out and earn $50 million. If they earn $50 million, the IRS would take 35% of that, which is $17.5 million. That would leave them with only $32.5 million. Not enough. Big shortfall.
So they have to gross up that income. They have to aim higher.
Yes. The formula is the shortfall divided by, in parentheses, 1 minus the tax rate. So $50 million divided by 1 minus 0.35.
So $50 million divided by 0.65.
Which comes out to roughly $77 million.
Wow.
So to pay that final $50 million of debt, they need to earn $77 million of pre-tax income. $27 million goes to the IRS, $50 million goes to the bank.
That is huge. That is a $27 million hidden cost that the standard DSCR formula doesn't show you at all.
Exactly. So let's add it all up. To pay the full $100 million debt, they need the original $50 million that was shielded plus the $77 million they had to earn to cover the taxable part. Total requirement, $127 million of pre-tax cash.
So if you were just using the basic math, you'd look at the bill and think, I need $100 million. But in reality, because of the tax code, you need $127 million.
And that gap, that $27 million gap, is where companies go bankrupt. They look at their standard DSCR, they think they have enough coverage, but the quarterly tax bill hits, and suddenly the cash drawer is completely empty. They miscalculated reality.
This is why the pre-tax provision method matters so much. It reviews the true, actual cash cost of the debt.
It answers the real question. How much do I really need to earn to keep the lights on and the bankers happy, considering Uncle Sam always eats first?
It effectively de-risks the analysis. It's a much more conservative, much more realistic view of solvency.
It is, and if you are out there analyzing a stock or looking at a company's books and you see they have massive principal repayments coming due and very little depreciation on their books, you need to be doing this math because the company might be a lot closer to the edge than it looks.
Wow. Okay, so we've gone from the basic pulse check all the way to advanced tax surgery. Let's zoom out and just summarize what we've learned today.
Well, we started with the basic definition. DSCR is the sleep at night number. It's net operating income divided by total debt service.
And we learned that the total debt part includes principal, because cash is king, it's all about liquidity. And the income part excludes depreciation and interest because we want to see the raw engine power of the asset itself.
Then we established the benchmarks. 1.0 is bare survival. Anything less is a slow death by 1,000 cuts. 1.25 is the general comfort zone for commercial real estate. But banks vary, and those loan covenants can trigger a default even if you're still making your payments.
We looked at the S&P case study from 2008. The huge lesson there was, beware the average. A portfolio can look shiny and healthy on the surface, 1.76x coverage, while having a cancerous tumor of bad loans, with a 38% decline growing right inside it.
And finally, we just tackled the pre-tax provision method. The critical realization that paying back principal is much harder than it looks because you have to pay taxes on that money first, unless you have enough depreciation to shield it.
So what does this all mean for you listening? Why should you care about this dry, academic-sounding ratio?
I think it comes down to reality testing. Whether you are buying a rental property, analyzing a stock for your portfolio, or running a small business, this ratio strips away all the noise. Accounting can be creative. Net income can be manipulated with all sorts of tricks. But DSCR, it's raw cash reality. Can you pay the bills or not?
It's the truth serum of finance.
It really is. It doesn't lie.
Before we go, I have a thought I want to throw at you. It stems from that S&P surprise.
Let's hear it.
We saw how a portfolio could improve its average health while specific parts of it were rotting. That 6% of loans that were just collapsing. It makes me wonder, when we look at the wider economy, are we making the same mistake? We hear headlines all the time, average GDP is up, or average unemployment is down. But does that high-level, comforting average hide deep structural rot in specific sectors or demographics? Are we looking at the shiny average and missing the cracks in the foundation, just like the investors in that 2008 mortgage pool?
That is a profound question. We often optimize society for the average and completely ignore the distribution. In that S&P pool, ignoring the tail risk of those 8 bad loans led to a sudden downgrade. In the wider economy, ignoring the pockets of distress because the average looks fine usually leads to social and economic shocks that nobody in charge seems to see coming.
Something to mull over the next time you see a headline about record highs.
Indeed. Always check the denominator and the outliers.
Words to live by. Thanks for listening to this deep dive. We'll catch you in the next one.